Hello, my name is Andrew Carr. I'm an analyst instructor here at Fundamental Edge, and I've partially graduated from short form video to long form video. We're standing up a new weekly series where what I'm going to do is go through some stock pitches that we've received, and I'm just going to call out kind of what works and what doesn't. What we've noticed here at Fundamental Edge, and it's certainly something I went through when I was a new analyst, is when you're early in your stock pitching career, you don't really have a good sense of what works and what doesn't. And even if you do get feedback, it's unclear how to unstick yourself from the problem that you may have found yourself in. So what I'm going to do in this series, and we're going to be posting hopefully weekly, is going through pitches that were great, and we talk about why they were great, or we go through pitches that need a little bit of improvement, and then we go through why they needed improvement. So I figured what better way to kick this off than by going through some of the pitches of the finalists from the WITG competition in 2025. So that's the Wharton Investment Trading Group. Now you may remember that there were over 100 submissions to that, and they weren't all full-fledged PowerPoints like what you can get on the website where you can download them. Instead, they were brief 2-page executive summaries. And so from that field of over 100 executive summaries, we had to find pitches that really stood out. So I'm going to show today's, I'm going to start with Udemy. Let me just get my screen over here all set up. So we're going to go through this, and then I'm going to call out a few things that jumped out at me as being good examples of what makes a pitch great. So let's start right here. Short Udemy, next 12 months, 21% IRR, 1.8x risk reward, okay. Market views Udemy's challenges as cyclical, but various analyses they do show that the problems are structural. And they also call it eroding pricing power. All right, looks like a red flag. Let's continue. Learning and development budgets, tightening, AI commoditizing, generic upskilling. So the value proposition is becoming irrelevant. Okay, brief business overview, and then we get down into here. So they show that they did a web scrape, and they call out that a little over 3/4 of these courses are at high risk of AI disruption, and they can actually already be replicated by other platforms that are out there. And we see, an indication that there's a little bit of a decline in MAB. So I think that's monthly active buyers. That's one thing the pitch could have done, is just define that at first and then use the acronym going forward. But all right, so we have a little bit of a call out in variance, and then content saturation. There was a thing here that I thought was pretty good, which is, sometimes you see this in stock pitches where people will do something personally and then make that the spotlight of the pitch. Here they do it and move on. So they became an instructor, and they're calling out a few different drivers that lead to a decline in average revenue per monthly buyer in 26. So overall 15% variance to sell-side consumer revenue. And there is another, so that, content commoditization, declining pricing power, budget tightness headwinds. And then also, this is another interesting thing. People ask, hey, I don't have access to alt data. What should I do? Well, Wayback Machine can show some changes. That doesn't require anything. And then also, there's the declining take rate here. I thought that was kind of interesting. Actually, I think, where was it? In the 10Q, I think it's called out that they think, yeah, here we go. In the Q, we may need to change our pricing, subscription, and contract models for our platform's offering. So take rate is declining, which removes incentives for instructors. There's this learning and development budget tightness that was validated by some checks. And also here, they've got a clean valuation table. So we see what the implied valuation is here. So what metric of revenue here times what multiple, the EV to sales over here. And here we get, okay, it's done relative to the base and the current share price. All right, so that's how we get this IRR here on the risk reward. So I think it's pretty clean on a number of fronts. And so what can we take away from this? Why did this advance to the finals? There were a few things that really stood out. So first, they've got the thesis right up here, laying it all out. So you kind of know what the headline is, and then you know what's going to be in the pitch, and you can decide kind of, does this make sense? Another thing they did is In addition to laying out the variant view, they also moved past kind of the personal test, because a channel check is a personal test. It's a personal interaction with somebody in the value chain. You don't want to rely on an N of one. So this really has a number of different individual checks. There's chats with sell side. They have different incentives, but that's also in here. And the idea here is just that you're aggregating your objective read on what's going on in the world and seeing what that translates into in terms of your numbers versus street numbers. So if I were to call out three things that made this pitch pretty good, one is the thesis was right up top, and it's right there with the risk reward and the IRR. Secondly, there's laying out the variant view and showing with value-added research kind of what the substantiation is of that variant view. And thirdly, we've got a nice valuation table in here. So we have multiple times metric. It's very easy for the audience to see what's going on here. And so those are some of the things that I would call out in this Udemy pitch. And, if you're interested in learning more about putting together an analysis or learning how to pitch stocks, for one, you can check our weekly videos that are going to be coming out where I'll go through pitches, but to do it in a more structured way, head over to fundamentedge.com/analyst-academy to learn more.